there, I'm Lindsay Biscaya, and welcome to Market Call. Mike Philbrick is on the show today. He is CEO of Resolve Asset Management, and we'll be taking your questions on exchange-traded funds. You can call us toll-free. The number is 1-855-326-6266, or you can send us an email to marketcall@bnnbloomberg.ca. And Mike Philbrick joins us now. Good to see you. Thanks for taking the time.
Good to see you, Lindsay.
Okay, so this is the second last day of 2025, and as we head into 2026, I guess we're going to be talking a little bit more about how you would advise investors to behave. Like you're saying, what maybe worked for people in 2025 might not work in 2026.
Well, exactly. The best lesson into 2026 is don't let the 2025 winners imprison you. Bull markets create this kind of behavioral flaw of playing with house money, and portfolios can quietly get over-risked. And so you've got to watch for the index concentration that's occurring today. That ends up being in concentrated leadership and a one theme bet. So step one is boring but powerful. Rebalance back to your target risk. The things like precious metals that we've been talking about for the last couple of years, technology stocks, these have probably ballooned to become a larger part of your portfolio. So start to look at that opportunity to rebalance. Don't wait for a pullback to discover that you're a little bit over on your risk budget.
Are there any sectors or areas in 2026 that you think might have a run that maybe didn't this year?
Well, yeah, I think that 2026, the horizon is full of opportunities for more market volatility. You've got a Fed chair change. You've got a potential debt ceiling issue at the end of January that has to be renegotiated. You've got changing inflation and growth expectations. For example, if disinflation outpaces the rate cuts, and that disinflation is the rate at which inflation is falling, if rates aren't being cut as fast or faster, what happens is real rates, those rates after you consider inflation, begin to rise. And so Fed easing can actually not function as a lift for stocks. It may not work like it did previously. So diversification really matters again. It's not even as much a return engine, but more a ballast and a rebalancing of opportunity for dry powder in your portfolio, using things like bonds or trend following managed futures strategies. They add that diversity and that rebalancing opportunity. And an option we like to take into consideration is one called return stacking. And return stacking is where you layer on your diversifier, whether that be bonds or managed futures trend. You layer that right on top of your stocks that you already own. This gives you the best of both worlds, keeping your equity exposure that you know, love, and trust, while layering on those diversifiers to get in front of the opportunity to diversify. The discipline of rebalancing and diversifying just never gets old.
Okay, good. You got to my last question for me, which was about bonds and trend strategy. So hopefully we can talk about that maybe a little later in the show as well. But we're going to take a quick break right now. We'll be back with Mike Philbrick of Resolve Asset Management, taking your questions on exchange-traded funds right after this. Stay with us. Welcome back to Market Call. We've got Mike Philbrick on the show today answering your questions, and we're going to start with an email, this one coming in from Brian, and it reads, the two top cybersecurity stocks, CRWD and PANW, have outperformed the hack and bug ETF. Does this indicate that they are in a dominant position in cybersecurity and make for better investments? Okay, Mike, what do you think about this?
Yeah, well, what the emailer is highlighting is a single stock risk, or what we call idiosyncratic risk, versus taking a sector risk or bet. So both of these ETFs, as mentioned, are in the cybersecurity area. So you've got hack and bug, which are ETFs, which represent stocks in that sector in its entirety. And CrowdStrike is a great case study because if you recall, they had a large global outage tied to a failure of an update, and that caused the stock to have a pretty precipitous decline. It caused the grounding of a bunch of airplanes, I think it was by United. And so, one operational mistake in one company, and if you own that company, has a pretty significant outcome for you. And so when you're buying an ETF, what you're saying is, I want to spread that across the whole industry. And that way you lower that concentration risk by getting the basket. And you're going to have some laggards in the basket. You're going to have some smaller names. So they're going to dilute that single stock performance, but they're also going to give you that diversity. Now, what someone might consider, an investor might consider, is a core satellite approach, where you take, you own either hack or bug or both, because you want that thematic exposure, but then you tilt modestly to a leader in the field that you have great conviction in. Let's say you had conviction in Palo Alto and CrowdStrike. You'd add a little bit and hold it beside your broad ETF sector-based allocation.
Okay. We're going to go to the phone lines now. Rob is calling in from Calgary with a question. Hi, Rob. What's your question?
Hi. Thanks for taking my call. I have a two-part question for Mike. First, I'm interested in investing in a high-tech ETF held in either Canadian or U.S. currency and holds a cross-section of the major U.S. tech firms. I'm considering HTA, the Harvest Tech Achievers Fund on the TSX. It holds U.S.-based stocks, and I believe it uses a cover call strategy, which leads me to the second part of my question, which is, isn't a cover call strategy counterproductive on high-tech, growth-oriented stocks, as presumably they should be called away as the stock appreciates? Or would you recommend that an ETF like this for those looking for both growth and income? Thanks very much for your advice, and have a Happy New Year.
Okay, thanks, Rob. Happy New Year. Let's start with the beginning of that question, Mike. The HTA, what do you think about HTA? Is that a good ETF to hold?
Yeah, so HTA is the Harvest Tech Achievers Growth and Income Fund, and it's a portfolio of large cap tech leaders with an active covered call overlay. And the nice thing here, the caller mentions that giving up the upside on the calls, up to 33% of the portfolio is covered written, meaning that you're selling some calls and taking that premium in, but you're leaving 2/3 of the portfolio to actually capture that full upside. And the caller is absolutely correct. Covered call ETFs basically turn some of tomorrow's growth into today's income. And that trade-off can be fine, but it's not a free lunch. And the caller hits that right nail on the head. If you look really long-term and you say, well, across all assets, and does covered writing actually add any returns? It actually generally does not. You get a little bit lower returns because you're capping that upside. But if you have a preference for having some income in the portfolio, then something like this product, I think, strikes a nice balance from the standpoint of allowing 2/3 of the portfolio to continue to run, while 1/3 of it creates some income. So it is a bit of a good hybrid solution for what the investor is talking about. Now, this particular one is currency hedged. They do have a non-currency hedged version. I think it's HTAE. But those are something to consider. I think for what the caller mentioned is that they want some income. This is probably a really good solution. Otherwise, if you want to get a lower fee, because the fee here is in the 99 basis point range. This is a bit higher too, so you're paying a higher fee than you would pay on, let's say, just buying the NASDAQ, some sort of NASDAQ ETF, which would cost you in a handful of basis points. So some things to think about.
Yeah, for sure. Okay, I think we covered all of that in that answer, Mike. Thanks for that. We're going to move on now. Michael's calling in from Hollywood, Florida with a question. Hi, Michael.
Hi, Mike. Thanks for taking my call. I'm a Canadian investor presently holding VFV, the unhedged S&P 500 ETF. Do you think it still makes sense to stay unhedged versus moving to a hedged version like VSP, given the cost of hedging and the idea that currency swings usually balance out over the long term? And secondly, at today's market levels and interest rate environment, do you think it still makes sense to be adding to the S&P 500 right now, or would you wait for better entry points?
Okay, thanks for your question. We'll start with that first part first, I guess, Mike. VFV or VSP?
Right. So VFV, as the caller points out, is not currency hedged, where the VSP has a CAD hedge on it. And really, the caller's bang on. In the long run, it doesn't really matter when you hedge the currency, but in the short term, and short term can be many, many years, one can think back to the 2003 to 2006-7 boom in commodities, and the Canadian dollar approached parity with the U.S. dollar. So over several years, quite a significant move can happen, and those are hard to predict. So something to think about is not going all or none, maybe holding a bit of each, because you hold the same underlying. And if you were to say hold half in each, you'd be half hedged and half unhedged. That would be a way to deal with the uncertainty of the Canadian hedge. As for allocating to the S&P 500, I think, that's the dominant index in the world. Working against it is, the valuations are high on the S&P 500. It's dominated by only 7 stocks. Not only, but large proportion of the index is in 7 stocks. And if you look at the sector weighting, there's very small weightings to anything resource related, energy related, things that are actually some of the base materials that are going into the AI build out. So just if we looked at the index by itself, it has a bit of concentration, but I'm not sure how the investor has mapped out the rest of the portfolio. So for example, if he has some S&P 500, but he also owns a bunch of Canadian exposure through the TSX, mid caps, large caps, well, that is resource heavy. And so that would be a nice balance. I'm just pointing out the index by itself is a bit of a tech bet. And that's something to just take into consideration as you're looking at your entire portfolio.
For sure. Okay, Mike, thanks for that. We're going to take a quick break right now, but we will be back with Mike Philbrick of Resolve Asset Management, taking your questions on ETFs right after this. Stay with us. Welcome back to Market Call. Mike Philbrick joining us to answer some questions today on ETFs. So, Mike, this first question coming in from Carrie. It's an email, and it reads, "Good day. Could I please get your thoughts on the ETF ENCC?" What are your thoughts?
Absolutely. So ENCC is the Global X equal weighted Canadian oil and gas equities plus covered calls income ETF. And so this is a great example. I'm not sure if we could put a chart up of ZEO and ENCC. If we can't, that's fine. I just want to demonstrate a point. Mm-hmm. So the equal weight covered call portfolio from Global X writes those calls on that Canadian oil and gas equal weight portfolio. So the thing that's nice about that is that's for income-oriented energy exposure. So if you're ZEO, so that's the BMO equal weight, yeah. And if you look at the performance over the last sort of year, the 1-year performance on ENCC has been 12%, while the performance on ZEO has been 13%. If you expand that to 3 years, you see ZEO rises 46% over 3 years, and ENCC rises only 40%. And that small reduction in return is what you're paying because you're covered writing. You're selling some of that future growth in this portfolio of oil and gas stocks in order to create some current income. I just want to point that out. That's neither good nor bad. If you're an income-oriented investor who wants some energy exposure, then working a covered right strategy on top of that oil and gas index and creating the income and having a little bit of buffer to the downside and getting some call premium in while you wait is a perfectly viable option and thing to do. I often want to make sure the covered calls don't cover the whole portfolio. They're more just a portion of the portfolio, allowing some of that portfolio to run as it grows, because you do have this one sort of fly in the ointment of covered call writing strategies, which is you are selling that upside growth for income today. And just you want to be aware of that. So this is a great strategy. Also in the oil and gas area, those stocks tend to have a bit more volatility. So those call premiums are a little bit higher, which adds a little bit more income to the portfolio.
All right. We're going to move on now. Alan is calling in from Montreal with a question. Hi, Alan.
Hi. Thank you very much, Mike. Thank you for taking my call. Mike, I have a lot of U.S. dollars sitting in a regular high-interest, daily interest account in U.S. dollars. I understand that there are a couple of companies, Vanguard and Global X has Treasury bills, 3 or 4 month Treasury bills, in which I can get a much higher yield, like around 4%. I would like your opinion on which you would recommend. Thank you and happy holidays.
Okay, thank you for that. Vanguard, or I believe you said Global X. Mike, what are your thoughts on what you would recommend?
The Global X 1 to 3 month T-bill ETF is probably the right call here. And that one is, let me just look, that's not it. Sorry, apologies for this. It's a bit of a, looks like CLIP, C-L-I-P.
C-L-I-P.
And CLIP would be the, let me just make sure. Yeah, that's the 1 to 3 month T-bill ETF. And that's ultra short term. Oh, he said US dollars, correct?
Yes. Yeah.
Yes. Okay. Yeah. So that is the US dollar 1 to 3 month T-bill ETF. And the yield there is about 3.7% ish. And you're talking about the highest grade quality collateral in US Treasury bills.
Okay. All right. We're going to move on to another question. This one coming in from Nick, who's calling in from Toronto with a question. Hi, Nick. What's your question?
Hello, Lindsay. Hello, Mike. Wish both of you happy holidays. My question is, yeah, you're welcome. My question is regarding a few of these ETFs on the NASDAQ. The first one is WPay. P as in Papa. So it's WPay, then Maxi, and Chippy. I will hang up. And, I'm sorry?
Nick, do you want to just repeat those one more time for us?
Yeah, for sure. It's WPay.
Okay.
Then like WPAY?
P as in Papa, A-Y.
I gotcha. Yeah.
Okay, thank you. And WPay Maxi, M-A-X-I.
Okay. Or CHPY, is that what you were asking about? All right, Mike, do you want to, thanks, Nick, for your question. Mike, do you want to go over, let's start with CHPY and go over what your thoughts are on that.
Okay, CHPY. There was a few put in there on that.
There was a couple there. I don't know. You can choose which one you want to start with, WPAY or CHPY.
Well, let's start with WPAY, which is the Round Hills Weekly Pay Universe ETF. Now, this is a basket of single stock weekly pay ETFs, and so these are, I would say. If you're looking for option income on single name stock ETFs and you want weekly cash flow, these are okay. But these are kind of ringing to me as a little bit of excessive on the income seeking side. Do you really need weekly income from the portfolio and then having single issuers and then the cost is 99 basis points? And then, on single stocks, you remember I said in covered writing, if a stock rips higher, you give up all the upside. Part of the advantage of writing a basket of stocks is you have a chance of keeping that basket because the moves aren't so extreme. And so you run into really kind of clipping the tops off or selling a lot of growth for the current income for these types of products. And I think they're all that. So the Yield Max, the Chippy is the Yield Max Semiconductor portfolio option income, which would be the same thing. Just know what you're getting into, maybe a smaller portion of the portfolio, to be creating, on Chippy, the semiconductor portfolio, it's all semiconductor stocks. They're going to swim as a school of fish. As we talked about, some of the fish may be bigger or stronger, but it is a school of fish as they swim together. So they're going to move together. And that's a lot of volatility that you're trying to create some income from. So it's just not for the faint of heart, for sure. And you'd have to be a pretty savvy investor to be involved in those ETFs.
All right, we're going to take a quick break now, Mike. Thanks for that. We're going to take a break, and when we return, we'll take a look at Mike's past picks. That's next. Stay with us. Welcome back to Market Call. Mike Philbrick is joining us today, and now we're going to go over some of his past picks. These are from April 11th, 2025. So, Mike, we'll start with the first one. This is the ETF XMU trading on the TSX. Did pretty well, recommended at $83.92, now at $87.38. Do you still like this one?
I do. And there's, again, if we rewind to April 2025, that was the tariff tantrum. Lots of noise, lots of uncertainty, markets in the headlines, and a pretty messy tape. And so these recommendations back then were to serve to be a calm in the storm. And that's exactly what XMU is. When you look at a min vol and the US index, you're seeing that tariff tantrum wasn't as big a drawdown. And that's how it works. They're looking at the portfolio and they're constructing a portfolio of stocks with a lower volatility than the market itself. It helps you avoid market concentration in those 7 concentrated stocks. At the same time, that sword cuts 2 ways, because if you're not focused in those 7 stocks for the balance of the year, your rally wasn't as significant. So you can lag in those sharp speculative melt-ups in an ETF approach like this, but it keeps you in the game, and it keeps you have the ability to be exposed. And I think that theme continues in 2026.
Mm-hmm. It's funny, when you look at that chart, you can see April, as you mentioned, that's really when when a lot of the tariff volatility started. You can see the volatility in the ETF as well. Your next one, BMO Long-Term U.S. Treasury Bond Index ETF. This one, when recommended, was at $36.77, now at $36.94. So total return about 3% since April. You still like this one as well?
Yeah, and for the same reasons. I think 2026 can have some of these shocks that we've talked about earlier in the market commentary. And so this is your long U.S. bonds, and this is that crisis ballast or convexity that those long treasuries, if you get a growth scare or a growth shock, they can do well. And why that makes sense is it allows you to have something in your portfolio to go to in order to rebalance when you see equities and other types of assets are on sale. And so you want to make sure today that your risk is right, make sure you get your bond exposure correct, because there will be more volatility over 2026. And having this ballast not only gives you diversification, but it gives you a source of funds to rebalance with.
All right, and your last past pick, the ETF VIU trading on the TSX. We'll take a look at what that was recommended at back in April, $34.52, now sitting at $43. So this one did not bad over the course of majority of the year.
Right, and this was the diversify away from the U.S. and that concentration in that tech era, and so that got you into the sort of the other developed countries in the world, places like Europe and Asia, where markets actually aren't expensive. You hear a lot about markets are expensive. That doesn't necessarily mean that they're going to go down. Expensive just means in the longer term you might expect lower returns, but you can have higher returns too. But in those non-North American markets, what we found is those valuations were average. And so it was a place to continue to have exposure, get away from that U.S. dominance, and worked out well.
It worked out well?
And
okay.
Still applicable still applicable today.
So still applicable heading into 2026 as well, you think?
Yes.
Okay.
Yep.
All right, we're going to take another quick break. We'll be back with Mike Philbrick of Resolve Asset Management, taking your questions on ETFs coming up right after the break. Stay with us. Welcome back to Market Call. Mike Philbrick joining us again to answer some of your questions on ETFs. And Mike, we're going to start with a phone line question. Frank is calling in from Ottawa. Hi, Frank. What's your question?
Hi. Thanks for taking my call. Mike, I believe you have been one of the few who have been constructive on the cryptocurrencies, Bitcoin and Ethereum. Given that 2025 started pretty good, but they're ending in a pretty negative territory. What are your thoughts going forward on these versus gold, or should we just stick with gold and silver? And if you can suggest an ETF which can be available on the Canadian side, I've been using. I've been thinking of leveraging BMNR or MSTR, but they are obviously leveraged, so I'm not sure if they're the right choice. Thank you.
Okay, thanks for your questions. Okay, so Mike, I'm not sure if you have any thoughts on any of the ETFs that Frank just mentioned, or if you have a recommendation for an Ethereum ETF.
Absolutely. First, I think we need to cover off the Ethereum landscape. And no, price is volatile, obviously, in these asset classes. And these asset classes are trying to discount a future value for what the value of Ethereum might be. And we have to look at under the surface what's actually happening. And it's incredibly bullish. We had the Clarity Act come out of the US that clarified how digital assets were going to be considered. Then you had the Genius Act basically putting in play how we were going to start clearing stable coins and real world assets through digital assets. And Ethereum has risen to the top as being the largest network, the most secure network. And now we have Paul Atkins in at the SEC. The name of the gentleman escapes me at the CFTC, all pro crypto. So in my mind, whilst price is struggling underneath the surface, you are seeing adoption at the institutional level using this technology to shorten settlement. Remember, settlement still takes a day or two, and that money is captured for a day or two and it's useless. The velocity of money increases dramatically when you can settle in minutes. And that's why the US is pursuing this. If you can't own the global currency, own the protocol. And so that's what's happening under the surface. So to me, that's very bullish on Ethereum. But Ethereum is also an asset class that's trying to discount a future that's swinging all over the place. So it's going to be volatile. You need to account for that in your position sizing. And then lastly, I would say if you're looking for a Canadian exposure, Canadian listed, FETH is Fidelity's spot Ethereum ETF in Canada. And it is exposure directly to the Ethereum blockchain, and that should give you your exposure, and the management fee is 39 basis points. So it comes in nice, cheap, and cheerful and gets you the exposure you need.
FETH. All right, hopefully that answers the question, Mike. Thanks for that. Jay is now calling with a question from Brampton. Hi, Jay.
Hi, Mike. Hope you're doing well. I own a CGMU, and it's a levered operator on a Canadian gold miners. I'm seeing a bit of pullback in gold stocks, and I'm a bit worried. What's your outlook on gold, and do you think gold miners continue to capitalize on it if it's a positive outlook?
Okay, thanks for your question. Mike, what are your thoughts on gold? I know the last caller kind of mentioned that as well.
Yeah, so I'm actually still constructive on gold, but remember, we've been chatting about gold for probably the better part of 2 years on these shows, urging folks to make sure they have an allocation to gold because it's a scarce asset. The fact that it doesn't create cash flows, that's not a bug, it's a feature. Scarce assets must be bought from somebody else who owns them. They can't be printed or produced out of thin air. If we need more iPhones will be built. Where gold and silver, those don't quite work that way. But we have had a pretty significant run from where we were a couple of years ago. So this comes back to what I talked about at the beginning of the show. And that is, you could have a situation where these positions have grown to be quite large. I think silver is up over 100 and some odd percent, and gold's up 60 or 80% this year. And so these positions will grow to a place in your portfolio where they may be a little bit too big. And so you've got to be looking at making that adjustment, rebalancing, cutting exposure a little bit as these positions grow. So I think that's just good portfolio management hygiene. As for the gold stocks, they're going to contribute, they're going to continue to participate. Money goes to where it's treated best. And right now, their profit margins are exploding because of the price of gold. As they dig it out of the ground, it's worth more. Their hedges are rolling off. So, in general, it all still looks good. I think there isn't the asymmetric upside we used to have. I think there's still upside. And it really is a diversifying asset because of its scarcity. So just make sure your position sizing is correct. Maybe take a look at rebalancing and trimming. If you have no exposure, look at these pullbacks as opportunities to crawl, walk, run. Don't chase, but start to build a small position in your portfolio. And as it shows you some profits, maybe build on that.
Okay, thanks for that. Now we're going to go back to the phone line. Steve calling in from Richmond Hill with a question. Hi, Steve.
Good morning. How you doing?
I'm good. How are you?
Pretty good. Sorry, good afternoon. Thank you very much for taking my call. Back in late August, I was listening to Mike. He threw out a little thing about iShares silver bullion. I took a small position, and it's done very, very well. Is that a hold or a sell, or should I buy some more? And is there an equivalent gold product as well? I'll hang up and listen to your answers. Thank you very much.
Thank you. Yeah, it looks like it has done pretty well. Always nice to hear. Mike, what are your thoughts?
I think this falls into the same camp as we just had the discussion on gold. So you've got a small position. That's great. And this is not personal investment advice. So I know you bought it and all that sort of stuff. But in a portfolio construct, I don't know how much you bought. If it was a de minimis enough position and it's just growing to something you're comfortable with, that's fine. If it's 25% of your portfolio, that's probably too large. So that's where you have to think about, how do you trim? Do you pare back a little bit? It's going to be volatile. You saw the volatility yesterday. You're seeing margin rates increase in the futures markets. So there is a lot of angst. You're seeing prices in Shanghai be anywhere from $4 to $7 higher in the actual physical markets than what we see trading in North America and Europe. So something's certainly afoot. And if you've got a good buffer on it, you could probably keep a little bit more. But also don't let the tail wag the dog here, right? You've had a good run. I don't know how big the position was. I would allow for it to base a little bit here. If you didn't own any, then it would be that crawl, walk, run scenario, maybe add a little bit. If you do own some and you're really comfortable because the position size is within your risk budget, you can continue to hold it and ignore it. Still bullish on silver. It's got a number of uses in whether it's solar or data centers. And there's an awful lot of paper silver out there that is supported by a smaller physical market. So there could be some more upside, but there will be volatility. On the gold side, yes, the CGL, which is the iShares gold bullion ETF, also CAD hedged with the H on it in Canada, is the one you'd probably go with if you're looking for one. But there are several others in Canada. There's MNT by the Royal Canadian Mint, where they actually hold, that's an ETR, so they're actually holding the gold ounces. CGL holds a lot of the gold ounces. It does some work with the futures market for positioning and whatnot. But I think that'll get you a long way.
Okay, thanks for that, Mike. And we're going to be back in just a moment with Mike Philbrick of Resolve Asset Management, taking more of your questions on ETFs. But we're going to take a quick break first. Stay with us. Welcome back to Market Call. Mike Philbrick joining us once again. We're going to go right to the phone lines. Chris is calling in from Delta, BC with a question. Hi, Chris.
Oh, hello, Lindsay. Hello, Mike. Thank you so much for taking my call. Just really quickly want to give my appreciation to the person on the switchboard today. Amazing job, as always, sincerely. And I hope she's acknowledged. And Mike, my question, perfect, is on PPH, the pharmaceutical company ETF. I'm wondering if that is still sort of the main OG ETF in that space, if you will. If I gather from my recollection, there aren't a lot of specific drug maker ETFs, and just like your thoughts on that, and maybe the industry, any advice in terms of long-term investing there. Thank you so much, and have a great day to both of you.
Okay, thanks so much, Chris. So, Mike, what do you think? PPH, is that still kind of the leader in the pharmaceutical ETFs, or is there something else that you're keeping an eye on?
Nope, that is the OG, if you will, and you're talking about 1.1, 1.2 billion in assets and $500 or $600 million traded a day. So it is the OG and a nice low fee, 36 basis point MER for that exposure. So as mentioned, it's a pharmaceutical ETF focused on a basket of large pharma names. And the nice thing here is this is typically a defensive quality healthcare equity tilt play, which I think is actually opportune for next year because you can dampen some of the volatility. But also what's interesting about this space is the way AI is going to be employed in the rapid development, production, and deployment of drugs and those types of things for improved and enhanced health outcomes. And so that, to me, this is one of those AI adjacent opportunities where AI is going to have a significant impact on this. And buying this as a sector, I think, has some pretty exceptional growth opportunities. And this is cheap as it comes, and large companies as well, with that nice defensive tilt to the sector. Great call.
Okay, good to know. Thanks, Mike. So we're going to move on now. Steve is calling in from Ottawa with a question. Hi, Steve.
Hi, Lindsay. Thanks so much for taking my call. Great job, as usual, on the show, and to everybody there that makes things work. Along the lines of your opening comments, Mike, I was looking to de-risk a portfolio that has a weighting of about 95% equities. And as such, I was looking for a short-term bond ETF on the Canadian market. I was considering HFR. What are your thoughts on that, please?
Okay, thanks, Steve, for your question. So, yeah, looking to diversify heading into the new year. HFR, I'm not sure if you have any thoughts on that, or if you have any other thoughts on how to diversify.
I think I misheard it as XFR.
XFR. Oh, sorry, yes, XFR.
But I think that's what I heard. No, I think the caller did say HFR. So HFR is the Global X Active Ultra Short Term Investment Grade Bond ETF, and yields in the 3% range. I think that is a great choice. If you're looking for specifically, I want to de-risk, I want to have some cash, I don't want a lot of volatility in the portfolio, I think that's a wonderful choice. You could, that's a 49 basis point cost, and so you could look at the BMO Ultra Short Term Bond ETF, ZST. That's got a 17 basis point fee. So have a look at that. It's a slightly lower yield because it's not corporates, it's not investment grade. It's a little higher quality, but the fee is lower. I'll leave that with you. But those are great places to just have some cash in the silence.
Okay, thanks for that. We're going to move on now. Tom is calling in from Toronto with a question. Hi, Tom.
Hello. Good afternoon. Thank you for taking my call. Can I get Mike's opinion on the Australia ETF, good way to play the Asia market, please? Thank you.
Okay, thanks, Tom, for that. Mike, what are your thoughts? I mean, a little bit of diversification into Australia ETFs.
Yeah, the caller was referring to EWA. That's the iShares MSCI Australia ETF, which trades the large and mid-cap Australian equities. Just on a country basis. So Australia is resource rich, tends to be heavy in financials and materials. So think of it as the Canada, but being materials rather than hydrocarbons. And so this will participate in the global reflation trade and that commodity exposure. I kind of, it's a funny thing. He's connecting it to Asia. I might just buy something in Asia instead. And if I was looking for the reflation trade, we're already seeing it manifest more strongly in Canada than we are in Australia. So, being that we're in Canada, I would probably skew to just holding on to my Canadian assets. If I was looking for some Asian exposure, I would look for an ETF in that realm, and there's lots of them. And just see if I can. I'll leave that, though. I know we're pressed for time.
You'll leave that where it is? Okay. Hopefully that answers the question. Mike, thanks so much for that. And we're going to take another quick break now. When we return, though, we'll take a look at Mike's new top picks. Stay with us. Join us tomorrow on Market Call. Brendan Caldwell will be on the show. He's president and CEO of Caldwell Investment Management, and we'll be taking your questions on North American large caps. And if you miss Market Call, you can always check out our daily podcast. You can find it on iHeartRadio and other platforms, and you can also watch full episodes on our YouTube channel. Mike Philbrick is back with us, and it's time now for top picks. So, Mike, we're going to go through these. Your first top pick is Vanguard Canadian Government Bond Index ETF trading on the TSX. What is it that you like about this one?
Well, this is my ballast pick. This is the high-quality government bonds to stabilize that ride and give you some dry powder to rebalance if equities wobble. You know, I think we're at the end of 2025, going into 2026. Now's the opportunity. Make sure your risk is right. Don't discover your risk tolerance in a drawdown. That's very dangerous. So 2026 looks like, you know, a multi-regime kind of year with some policy uncertainty, as we've discussed. And so I think bonds can finally hedge again. The yields are meaningful. And so this provides for the opportunity to diversify and rebalance as any kind of wayward action in the markets happens over the coming year.
Okay, and yeah, for people that maybe missed the top of the show, we were talking about that as we head into 2026, trying to rebalance and diversify a little bit more. That's some of your advice there. If we go to your next top pick, this is the ETF XEG trading on the TSX. What do you like about this one?
Correct. Now, if there's one thing that could really undermine things in the sort of the development of markets and global trade is an oil price shock. You know, so an oil shock that would lead to an inflation shock. This would curtail growth. It would have some stifling effects. And so, you know, having a little bit of energy exposure is one of those few areas that can help hedge that and provide some positive impact to the portfolio if we were to get an oil shock. And so that's something to think about. Now, if you've already got broad-based Canadian equity exposure, you've got lots of energy exposure. You don't necessarily need this. If you've skewed your portfolio largely to the U.S., you've got de minimis energy exposure. So it's just something to think about. This is a risk that if we got some sort of issue coming out of the UK, Ukraine, or Russia, or there was some spike in oil prices, that would have a definite, that would create a growth shock and stocks would feel that. And so that's the one thing that could happen that's a little bit ugly. So that this is a hedge for that particular opportunity. And we did talk about the ENCC and the covered written ETFs earlier. Those are the fine substitutes as well.
And your last one, Invesco Solar ETF. I think this is really interesting how you tie this into the demand for AI power that we're going to see, especially into the future, and different types of power. Is that kind of why you chose this one?
Bang on. This is a little bit of spice, a little bit of cayenne for the picks today. So this is the satellite bet on that AI build out and the power build out that's required. We always have to remember that AI is not in the cloud. It's not vibes. It's data centers built on the ground that need to be powered. And it isn't just chips, it's electricity, right? Grids, storage, electrification. And solar is one pathway for incremental power supply. And then there's a CapEx cycle around that, which is accelerating. For now, AI, is the bottleneck is power. And we're going to need every bit of energy, including solar, including wind, including hydrocarbons, in order to get things done. So this is a little bit of advice, as I say, a little cayenne, some spice. It is much more volatile and is rate and policy sensitive. So make sure you keep the sizing appropriate.
It is interesting to see, like, going back on some of your advice off the top of the show that we talked about as we head into 2026 is, you know, what had a big run in 2025 might not necessarily have that run in 2026. But when you look at an ETF like this, you can kind of build on something that did have a run in 2025, right? Like AI and a lot of these big companies that are building data centers or some of the metals, copper, silver, that are needed for data centers. You can look at that and then make your picks moving forward in terms of what we might need next.
Yeah, and the Canadian market, we've talked about XMD and XCS, which are the small cap and mid cap ETFs in Canada, which are focused in a lot of the industrials and materials and energy space. And so Canada has quite an array of opportunities to diversify and take advantage of the AI build out in all the materials and energy that's going to be required. So it's quite a nice place to be.
Okay, Mike, thanks so much for your time today. Appreciate you coming on. Happy New Year, and we'll see you no doubt in 2026.
Happy New Year, Lindsay.
Before we wrap up here, we're just going to take a quick look at the markets because we have a little bit of time on our hands. If we take a look at the U.S. markets today, they're all trending down. Not really too much movement. The S&P 500 down. The Dow Jones is down 0.1%. The NASDAQ composite also down by 0.03%. So really pretty flat today as we head into what is the second last day of 2025. And I believe we have the TSX as well. We can take a quick look at that. It saw some record highs over the last couple of days, fell flat yesterday. Today, you can see it is up, and even over the last year, look at that climb. So a bit of volatility to end out the year, but many economists saying that this is pretty normal as we wrap up 2025, head into 2026. And thanks for watching Market Call today. We will see you next time.